Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, stocks rebounding from Friday's sell-off as investors speculate about whether rate cuts are on the table. We'll discuss. Plus, we'll look at the potential successors to the open posts now at the BLS and the Fed, as President Trump says candidates will be named in the coming days. And we push ahead to Palantir and AMD results this week. Will the earnings momentum continue? All that and more coming up on Market Catalysts. Let's start, though, with a check at the markets here. We do have a pretty big rebound from the losses that we witnessed on Friday. The Dow right now up more than 400 points, about 0.9%. The S&P 500 up about 1.2%. The Nasdaq up 1.5%. Combination of factors here as investors take another look at the jobs numbers that we got on Friday. I've seen some interpretations that say maybe they weren't as bad as they seemed at first blush, and yet others who say, well, this makes a Fed rate cut more likely, which could be positive for risk assets like stocks. And then, of course, we've talked to a lot of folks who say earnings growth is strong, and that's the thing that is propelling stocks higher. We'll continue that discussion over the next couple of hours. And let's talk about the bond market, too, because we are seeing yields continue to come down on that speculation about what the Fed may do next. Right now, the 10-year yield, 4.22%. Well, President Trump accused the head of the Bureau of Labor Statistics of inflating payrolls numbers ahead of the 2024 election. Days after firing the commissioner in response to weaker than expected July jobs data, members of administration attempted to justify the shock move over the weekend. Joining me now, Yahoo Finance Washington correspondent Ben Worskell and Jay Pulaski, TPW Advisory founder. Gentlemen, thanks for being here. In fact, those jobs revisions didn't play out before the election exactly as the president outlined. But Ben, how is this playing out in Washington?
Yes, what we've seen over the weekend is in response to all these moves, this move from the president that surprised pretty much everyone, a bit of an attempt from his team to contain the fallout a little bit. We saw a case from Kevin Hassett on Meet the Press on Sunday, essentially that he wouldn't go as far as Trump, who has called these numbers a scam. He called them rigged in the last hour, but to say that this is essentially about getting a fresh pair of eyes at the Bureau of Labor Statistics, and the quote was that the president wants his own people there. Even as Hassett and others have said that these revisions that you mentioned are suspicious, and they're going to be doing a lot of investigation there. So this is kind of an attempt to move forward with this. As you mentioned, President Trump is going to pick his replacement in the next couple of days. He says he'll announce it by Wednesday or so. But for now, what we're going to that pick will have a Senate confirmation process, and what we're going to see is that the deputy commissioner is currently in charge. This is a career staffer who, according to his LinkedIn, has been there for 45 years. So a bit of a sort of steady as we go at the BLS at the moment, but with this pick coming and changes perhaps a little further on the horizon.
Jay, as we look at this whole process here, as we talked about earlier with an investor, the market hinges on these numbers, right? They're very closely watched. They're traded upon a lot. Do we have to worry about the integrity of the numbers if President Trump puts his own appointee in there?
100%, Julie. This is just another example of the dismantling of American exceptionalism. And, you hear people talk all the time about China and how you can't trust the statistics in China. And so, we've been bullish on China for the last couple of years at this point. And, China trades at 12 times earnings. The U.S. trades at 22 times earnings, in part because folks feel they can trust the information that comes out of the U.S. government. When a leader puts his own or her own people in positions of power like this over economic statistics, which markets depend on, you get conditions like what's happened in Turkey, right? Investors know this. We've seen this playbook before. This is not good. This is not the way free markets are supposed to operate. This is, in fact, rigging the game. And so, yes, it's another example of the dismantling of American exceptionalism that we've seen through tariffs, through the immigration process, and on and on and on.
And Ben, this isn't even the first time that we've seen the Trump himself or the Trump team be unhappy with data coming out of Washington. But how's it played out in the past that might tell us about how it can play out this time?
For sure. Yeah, this has definitely been a sort of second-term Trump project from his team as a whole. What we saw on Friday was an escalation in a whole bunch of levels, from the firing of the commissioner to the kind of wholesale saying that numbers are fake. But this has been a critique from them. GDP is a major one that's been in focus. It was especially in focus in spring. The idea from Trump's team was that GDP needed to be measured differently to exclude government data. That is sort of convenient for them because it allows the cost of government cuts to not be seen. So it makes the economy look better on that front. Even on jobs, there's a dissension there in terms of what to focus on. I think the way to think about it is looking at different slices. We saw J.D. Vance even on Friday afternoon touting native-born job gains as opposed to the entire jobs number. This is a number that we've seen a focus on from Trump over the whole year, to sort of say that these jobs numbers are better than they look, especially for Americans. So there's a lot of kind of dissension within the team and a debate that I think is going to shape everything going forward here, both in terms of who Trump picks and sort of the actual changes we see at the Bureau of Labor Statistics in the months and years ahead.
Of course, leaving aside the fact that there are many folks who are not native born who are legally Americans, but
Absolutely.
we'll leave that aside for a moment. So Jay, as an investor, what does it say to you that we come in this morning, we see the market going up, right? Because if we are seeing this dismantling that you're describing, that's certainly not reflected in U.S. equities either today or what we have seen as of late.
Well, I would respectfully disagree with that, Julie, right? U.S. equities are massively underperforming year to date.
They're
right?
underperforming, but they keep hitting records.
Right, but those two things can both be true, right? We're focused, again, kind of to the point of the debate we're having, we're focused as global investors on the best opportunities around the globe, not whether the S&P is hitting new highs. So for us, the metric that we measure is US global equities are up about 12%. U.S. is up about 6%. Non-U.S. equities, ex-U.S. is up about 16%. Emerging markets up about 17%. European markets up 17%. So actually the U.S. is a massive underperformer. And so we think that's going to continue. So our view has been for the last couple months is to sell U.S. RIPs. So when the market rips higher as it has over the last couple months, to your point, we want to be reducing that, taking profits in the U.S., and we want to be buying non-U.S. dips. So when the non-U.S. markets pull back, we want to be adding to them because we believe that 6 months, 12 months down the road, conditions in Europe are going to be better. Fiscal stimulus, the benefits of ECB rate cuts. Conditions in China going to be better. Lots of liquidity, addressing the excess competition, addressing the lack of consumption. China now providing cash handouts to families that have children. That's a first, breaking a taboo in terms of providing direct cash handouts. So when we look at key parts of the world, emerging markets, and also commodities, we see a world that 6 to 12 months from now is going to be growing faster than the U.S., which is going to struggle with lack of immigration, with tariff effects, with higher inflation. And so we want to be continuously adding to the non-U.S. markets and to commodities, which we think are at the beginning of a secular bull market. And really, and the bottom line for us is the U.S. has been the place to be for the last 15 years in global equities. That's no longer the case. We're at the beginning of a secular leadership change away from U.S. equities to the rest of the world, and that's where we want to be adding to.
And I want to talk more about this. Ben, before we sort of dig into that a little bit more, I do want to get the latest from you on what's going on with the tariff negotiations and trade, particularly as it pertains to China, because we got a little bit of direction on that over the weekend. Yeah,
we did. So we have a couple deadlines looming this week, and then China next week. First is the reciprocal tariffs deadline. That's going to go into effect on Thursday, according to Trump's team. This is kind of basically everyone in the world except for China. And then, as you mentioned, next week is the August 12th deadline for China. We did get some guidance there from Trade Representative Jameson Greer, who again sort of echoed, wouldn't say specifically that there's going to be an extension of the tariffs on the horizon. The line we're hearing from the Trump team for days now is that there's still technical details to be worked out and that Trump is going to make the final decision. But there's a widespread expectation there that at least another 90-day delay on tariffs is in the offing. And then on one of the biggest issues front and center right now is rare earth minerals. The way Greer has described it is they're halfway there to work out a rare earth minerals deal about kind of China loosening their exports of these precious materials, which are crucial for the world economy. I think the overall takeaway from that detail is how slow these talks are going. Rare earths was of course the top agenda item in London a few months ago when they met last time, and it's clearly a lingering issue. We're seeing it in a lot of things. The Wall Street Journal had a good report today about how the military is really struggling to get the rare earth minerals it needs. So this is clearly a top line issue, and it shows how far the negotiators have to go to get to a lot of other issues, from currency, from intellectual property, that are going to take months and months and months to even get to.
So, Jay, I want to turn this last one to you as you talk about wanting to be elsewhere in the world, places like Europe and in emerging markets. What about the tariff effect on those places, right? I mean, yes, I know that they are passing on some of the cost to their customers, but not all, in not all cases. So do you expect some negative effects on the countries that are being tariffed, and how does that affect your investment thesis?
Sure. No, it's a good question, Julie. And I think the markets have already spoken, right? Going back to what we just talked about, U.S. has been underperforming. Market is already telling us that the bulk of the tariff impact, which will be negative, tariffs are a tax, right? There's a reason the world spent 50 odd years trying to reduce tariffs and boost global trade. Tariffs are a tax. Taxes are not great on economic growth, and therefore the market has spoken, both in terms of the stock market, U.S. underperforming, the currency market, dollar weak, the bond market, U.S. rates high, rest of the world cutting rates. The market has spoken already. Tariffs are a bigger impediment to the U.S. than to the rest of the world. And the real fear that we have at TBW Advisory is that the U.S. economy will continue to slow, and the market is expecting rate cuts, as you touched on at the open, but the Fed is going to have problems providing those rate cuts because inflation is well above target. Core PCE came in last week, 2.8%, Fed target 2%. So the Fed may not be ready or able to cut as much as the market would like them to. So when we look at the rest of the world, right, three things quickly on Europe. Record low unemployment, ECB rate cuts over the last year yet to be felt in terms of beneficial impact, and massive fiscal stimulus coming out of the core economy in Germany. All three are suggesting that growth will be better in Europe in 2026 and 2027 than it is today. Same in China. We wrote our piece, Friday Musings, Rates Rise in the East. The single biggest, most important macro factor that we're focused on is whether or not China can beat deflation. If China beats deflation, that means better growth in China, less risk of China exporting deflation to the rest of the world, higher corporate earnings in China, higher stock prices, higher multiples, and most likely a stronger currency. And so that's what we're really focused on. Can China defeat deflation? We think it will, and that's why we're long Chinese equities.
Jay, thank you so much. A really interesting conversation. Ben, thank you as well. Appreciate it.
Thanks, Julie.
Thanks. Coming up, we'll dig into Berkshire Hathaway earnings as we see those shares lower this morning. We'll be right back. Shares of Warren Buffett's Berkshire Hathaway sliding after it reported mixed results for the second quarter over the weekend, warning of considerable uncertainties generated in the first half by trade policy and tariffs. Also in focus, as always, is the company's cash pile, which now totals $344 billion. Here with more on the latest report and what's next for Berkshire is Kathy Seifert, CFRA Research VP of Equity Research. And Kathy, for context, has a hold on the stock of $535 price target. Kathy, it's good to see you. Interesting report from Berkshire. You had the Kraft Heinz write down, you had some insurance, volatility, I guess you could call it. What stands out to you as sort of the most important thing for investors to be watching?
I think there were a handful of things that people may want to focus on. And, one of the things, I do have a hold on the stock. I downgraded it late last year when I noticed that top line growth, revenue growth was slowing. And we saw that continuing this quarter with operating revenues, which exclude investment gains, down 1.2%. I think the lack of organic revenue growth removes a catalyst from the shares. The insurance results, as you noted, were mixed. Geico's results were actually not that bad. Their growth is less than that of some of their peers, but claim costs were sort of contained, which is a good thing. Berkshire's commercial lines businesses are still showing some deterioration and showing deterioration at a time when some of their peers have gotten a better handle on that. So that sort of laggard effect could drag into the next couple of quarters. That removes a catalyst from the shares. I think one of the big things, though, is that Berkshire didn't buy back any of their own shares. And the stock has been pretty weak since Buffett announced that he was retiring. The shares have sort of lagged the broader market. And so the combination of Berkshire not buying back their shares, coupled with the warning that the next couple of quarters could be difficult, definitely tempers my enthusiasm, and obviously that of a lot of investors, evidenced by this morning's performance.
I mean, and Berkshire not buying back its shares, they must know that sends a signal to the market, I would think, that they're not making that move, so that doesn't signal a huge vote of confidence. Is that unusual for Berkshire to be doing that?
No, I mean, Berkshire has a lot of companies and a lot of their peers, particularly in the insurance space where some companies have excess capital and they'll aggressively buy back stock. Unlike those companies, Berkshire's share repurchase policy states that they will buy back shares when Warren Buffett deems them to be below intrinsic value. And so, or i.e., a good value. And so I think the fact that, they have not bought back any shares this year, and for quite some time, it's been actually over a year, I think does send a pretty powerful message to the market, particularly when you look at the cash position, which at the end of June was over $340 billion.
So what do you think for a while, Buffett has said he's not necessarily seeing things that are worth spending that cash on, whether it's Berkshire's own shares or other stuff. Do you think investors are going to get impatient or have gotten impatient that money is not being spent?
Well, I mean, that's sort of the, kind of the favorite conversation around Berkshire is what are they going to do with the cash? And they obviously have a lot more patience than perhaps some of their investors do. There's talk right now, given what's going on in the rail space, that Berkshire may jump in and, add to the consolidation in the rail space. Ironically, one of the bright spots in this quarter's earnings were some improved operating efficiencies at Berkshire's rail operations, which may throw a little bit of cold water on the notion that they need to acquire to stay relevant and improve operating efficiencies. I also think Berkshire doesn't like to make acquisitions when there are market forces perhaps forcing their hand a little bit, like what we're seeing in the rail space. My sense is that, the market has underperformed, some of the broader other markets year to date, but valuations are still not that attractive, particularly my sense is through the eyes of a value investor like Warren Buffett.
So it sounds like you think a BNSF deal, at least in the near future, is unlikely.
Well, I think Berkshire is going to do what makes sense in that space. My sense is that they're not necessarily going to want to pay an inflated price. I think they've learned that lesson the hard way a number of years ago with some deals that Buffett has since acknowledged they overpaid for. And then you take that also against the backdrop of the fact that they just had to absorb a multi-billion-dollar write-down in a significant investment in Kraft Heinz, and the fact that the Occidental Petroleum deal, they're currently carrying about $5 billion above fair value. My sense is that they may be a little more guarded in the entry price that they get for their deals.
And Kathy, we're of course approaching Greg Abel taking over at the beginning of next year, will investors sort of give less of a pass to this company without Warren Buffett directly at the helm?
I think that's a really good question. And one of the things I think that investors are probably focused on and probably need to think about is that my sense is there may be pressure once Greg takes over for Berkshire to pay a cash dividend. They're one of the few components in the S&P 500, particularly given their size and their financial strength, to not pay a cash dividend. And I think that's one thing investors may want to focus on in a new management era at Berkshire. And I think the other thing investors are also focused on is that, and why the stock has underperformed, is that you have arguably one of the world's greatest investors stepping down from the helm of a very large conglomerate. The person taking over has a very solid industrial background, but does not have a professional money management background. And we really haven't heard a lot of detail about some of the kind of, I guess, second tier management strength at Berkshire. It's there. I think they would do investors and themselves a favor to highlight it, but we really haven't heard a lot of that. So there's a transition period in the broader economy that impacts Berkshire. There's also a transition at Berkshire that's impacting them. And, more information is better than less. And unfortunately, we haven't heard a lot of details about the transition.
We are waiting for them. Kathy, those shares down about 3% today, little changed on the year. Thank you so much.
Thanks. Nice being with you.
We got much more markets action coming up, including trending tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamama. We're live at the NASDAQ. Let's get a quick check of the market action about 1 hour into today's trading session. We're seeing all three major indices in the green, really bouncing back off of Friday's market sell-off. Taking a closer look at all three major indices, we have the NASDAQ really leading momentum here. It's up nearly 1.7%. Up around 340 points here as we make our way into today's trading session. The momentum there certainly with that AI tech rally underway. Dow also moving higher, up about 1 percentage point there, and the S&P 500 about up 1.2%. Taking a closer look at what exactly is trending, we also have that earnings report out from Palantir expected after market close today on Monday. That stock gaining a bit of momentum here, up 3.4%, really extending this momentum that we've seen year to date, heading into this key earnings report after market close, up more than 100%. Investors will be keeping a close ear or a close watch on what exactly they say about that latest contract with the U.S. Army and also how they're playing a key role in the AI arms race. Also trending on our site as well as Tesla, that stock up about 2% as we're really hearing more about the Tesla's board approving a $30 billion alternative compensation plan for CEO Elon Musk to really keep him on board, focus in on the company. That stock has been pressure year to date, down nearly 23%, down nearly 24%, as really this momentum has been around where Elon Musk stands in the company, how much of a focus he has in the company, and we've seen that sort of playing out year to date, but shares certainly rallying on this contract that could be underway. Also, if you take a look at the NASDAQ, this is something that was completely in the red on Friday as investors tried to assess that weaker than expected jobs data, the firing of the BLS director, and also that trade uncertainty. And now we're seeing a bit of a bounce back led by NVIDIA here. That stock up nearly 2.3%. Also rallying is Google, up nearly 3%. And Microsoft really holding on to momentum that it gained last week after seeing a bit of a dip on Friday's market sell-off after its cloud business outperformed what the street had expected. So the NASDAQ in the green. We also have the Dow mostly in the green as well. Amazon seeing a bit of a drop off there, continuing the momentum or the downtick that we saw on Thursday. And all three, or all their sectors rather, in the green as well. But keep it right here on Yahoo Finance. We're tracking all this data as we get into this week's trading session underway. Once again, all three major indices in the green this morning.
Now time for some of today's trending tickers. We are watching CommScope, Joby Aviation, and Wayfair. First up, a $10.5 billion deal between CommScope and Amphenol. CommScope will sell its broadband and cable equipment arm to Amphenol for about $10.5 billion in cash. It's the second such deal it's done with Amphenol as part of a series of divestitures aimed at paying off its debt. Amphenol, for its part, has made a string of acquisitions in recent years. Last year's deal for CommScope's outdoor wireless networks and distributed antenna systems businesses was the biggest ever by the Connecticut-based company at the time. This deal is expected to close in the first half of 2026. Next up is Joby Aviation. It said it plans to buy the helicopter rideshare business of Blade for as much as $125 million in stock or cash. The electric aviation pioneer is looking to expand its battery-powered air taxis into a ready-made market for its aircraft. The acquisition encompasses all of Blade's passenger business, including operations in the U.S. and Europe, as well as the Blade brand. Blade sells per-seat helicopter trips from New York City to nearby airports and resort towns. The company, which went public via SPAC 4 years ago, has not reported an annual profit since it listed. The company's shares are down 10% this year, giving it a market value of just over $300 million. And finally, Wayfair shares spiking today after the online retailer reported second quarter results that were much stronger than expected. Shares nearing a 2-year high as results point to a potential recovery in the furniture market, which has previously felt the impact of a depressed housing market and consumers opting to spend their cash on essentials. Wayfair's average order value in the second quarter was $328, up from $313 in the prior year's quarter. And as always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Palantir is set to report its second quarter results after the closing bell today. Joining me now, Maribel Lopez, Lopez Research founder. Maribel, this stock has continued to rocket, and the expectations have continued to be very, very high surrounding it. The challenge, I think, in many on the street's view, and I believe in your view, is the sort of balance in the company's businesses. Obviously, it has historically been very reliant on government contracts. It has grown its commercial business, but it's trying to grow it further. Do you think it can sort of rise to that challenge?
I think you hit the nail on the head right there. I think the issue is we've seen really strong overperforming growth in the government business. I still think there's upside in the government business as we look internationally. But the pace of growth in commercial really needs to accelerate if this stock is actually going to continue to have the performance that really has been priced into it at this point in time. It's an incredibly frothy AR market right now, and I think Palantir is a great example of lots of opportunity, but will the growth actually pace at what we've already valued them at?
And I guess where do you think the biggest opportunity is here? Because to your point, I mean, the expectations are so high around this stock. What do you feel like investors are looking for here? I mean, besides just the growth in commercial and, growth generally that the company is seeing, it's priced as though there is a real huge opportunity going forward for this company. What is that opportunity?
I think one thing that investors have really been focused on is, while we've been talking a lot about AI over the past couple of years, particularly in the commercial sector, we've really not seen the AI purchases yet. We're at the very beginning of that growth curve. And there's an understanding that that will fundamentally change who is going to be the next market leaders. And one of the things I think is so interesting about Palantir compared to some of the other AI bets that people are placing is the pick and shovel business has been the AI business to be in. If we're talking chips, if we're talking cloud, we're talking servers. But when you get to software, it's a lot harder to figure out what platforms are going to be successful moving forward. And I think Palantir has done a great job of positioning itself as one of the premier AI analytics companies. And with that government backdrop, people can feel a little more secure on the commercial side buying from them. So I think a lot of where we are with Palantir right now is that belief that there's still a fundamental hockey stick growth curve that we have yet to experience. And in some ways, I agree with that, but this is all about timing, which quarter, when, how many customers. And I think we're very excited. And I still think there's going to be a drag in terms of actual commercial adoption.
That said, does the sort of quarter by quarter adoption matter less if you're a believer in that long-term hockey stick? So will we, I mean, even if the stock reacts, which we might very well see, does it matter less?
So I think what happens is in the short run, it doesn't matter as much. In the long run, we're looking at who the transformative companies are and who people are placing bets on. And it's pretty clear that they've made some significant inroads in the AI category. So from that perspective, I think in the long run, they're still going to be one of the premier companies. That doesn't mean it's without risk, though. So for example, we talk a lot about what's happening with Grok, for example, in government and other opportunities for serious foundation models and players to come in and disrupt that. So they have a good foothold right now. They have to continue to maintain that and try to create a moat around it. But there are some forcing functions of other competitive pressures that might impact them in the long run as well. So it's still a little too early to say that they're going to run away with it all, but they've certainly put in a good foothold at the moment.
And speaking of competitive pressures, that brings us to one of the other companies reporting this week, AMD. And really, the competition is the story with AMD, from whether we're talking about NVIDIA or whether we're talking about companies like Broadcom as well. How do you think AMD is doing, and what are the results going to show to reflect that?
Yeah, in some ways, I think this is a completely different story because from the perspective of AMD, I do think that there's tremendous growth potential for them. The question is have we been over enthusiastic? Because realistically, when people are looking for AI investments, yes, there's AI in everything, but there are a few companies you can point to that are so very discretely AI focused, right? And chips is one of those categories. Where I see the big growth for AMD is both on the lower end, which is a CPU, and on the higher end, which is the GPU market. So they actually are playing both of those games, which is relatively unique in terms of competitor that can play both of those games well right now. And one of the things they have going for them is everybody wants to create a strong competitor to NVIDIA. And we thought for a long time that was going to be Intel. We saw what's happened with Intel. There's still opportunity for Intel to come back in and be a player. But right now, people are placing a second bet. They're placing that second bet on AMD. And that makes it a very interesting stock to have.
When you look at, we've had some guests say to us, well, AMD sort of provides a cheaper alternative to NVIDIA, not just talking about the chips, but the stock itself. Right. It has gotten a little bit less so. We've seen that the stock has recovered quite a bit, especially into these earnings. So again, just like we talked about with Palantir, what would you say about the expectations for AMD at this point?
So one thing I would say has been very interesting is that recent bump in pricing that they've had on their AI GPUs, right? Significant hike in pricing, which should actually help some of the margin issue that we've been thinking about with AMD. They've typically been known as a lower cost provider. That was sort of a Trojan horse strategy to get in. But if you're pricing yourself, even, in this case, it would be somewhere between 17 to 25% less than, a basic NVIDIA Blackwell GPU, it's still a value. And when you're buying that many of them in the hyperscaler landscape, there's still a lot of opportunity. So I think that there's some levers that AMD can still provide, but no doubt there's been just a tremendous run up in AMD. And as we mentioned earlier, Palantir, there's a lot of frothiness in the market, and the actual purchases might not meet today's frothiness.
We shall see after the close today for Palantir, after the close tomorrow for AMD. Thanks, Maribel. Appreciate it.
Thank you.
Coming up, we got to look into August seasonality in the markets and stocks and translation. Stay with us.
With July coming to an end and August trading right around the corner, in today's episode of Stocks in Translation, we are taking a look at seasonality for the month of August. And again, these are just the recurring patterns that we tend to see build in the market over time, not an exact science, and sometimes these patterns shift, but this is what I'm looking at right now. So here we have each of the 12 months, January through December, and this goes back to 1990. This shows the median returns, kind of similar to an average in green bars, and then in white, those white squares there, that is the percent positive. And what you're going to see here, August, notice August, these returns are not that spectacular. It's under 0.5%. It's not negative the way September is, but in fact, it is the third worst month of the year. And we're looking at a percent positive of only about 54%. And as a background reminder, I like to see that number above 70% because stocks usually go up. So August, usually not the best month. What you want to see is what tends to happen in March, April, and May here with nice positive returns, or October, November, even December here. But if you remember, March and April were not that great this year. So that is another reminder that seasonality, sometimes seasonality gets bucked and things can intervene and markets can go their own way. And of course, the tariffs, with a brand new president this year, with Trump and the tariffs, all of that took a U-turn. And this is the U that we were looking at in the market right here. This is in white, what we have seen year to date in the S&P 500. Now in blue and in green, I have two different maps. So the blue is a median since 1990. That matches what we were just looking at in that first chart. The green is another way of looking at the market and the seasonality. This goes back to 1928, and I'm only using the days when it's the same day of the week. So for instance, today is Monday, July 28th. I'm only looking at those Monday, July 28th going all the way back to 1928. So it's just a small subset of those years. But nevertheless, I found this particular way of looking at seasonality has very powerful predictive effects because it tends to track the holidays that we've seen in years past and 401k flows and all the things that affect seasonality. So what I'm seeing right here is we are right in the market right here. We tend not to have a stumble in this market model until we get to early October. And October, as I've said many times before, is prime time crash season. We actually get an uptick in volatility in September, but September, October, November are those months that you want to kind of watch out for. So now I'm going to zoom in on August alone, and I have these same two market maps that we were looking at before. Since 1928, same day of the week, that's in green here, and then since 1990, that is in blue. And what you're going to notice is we start off the month on a downbeat. That very first day tends to be historically negative, but then in both of these models, we eventually climb out from underwater. In the blue model, since 1990, it takes about half of the month, and we finally get there about 15th or 16th of the month. And then in the other model, since 1928, same day of the week, we get to positive territory a little bit earlier, and we end the month a bit higher. So we could have lackluster returns, and of course, anything could actually happen. We could have new tariff news that intervenes and takes the market down again. We could have something like a very optimistic or dovish Fed this week that sends the market higher. But in any case, I do want to close here with a bonus, and this is US dollar index seasonality. And I'm including it here because I have these two very similar models to what we were looking at before. Instead of 1990, I'm going all the way back to 1970 in blue. And then in green, I have since 1971, those years with the same day of the week. And I'm going to trace out that green. This is a model that I'm really paying attention to. It turns up right now, right at the end of July into early August, and it sends higher basically into the beginning of October here. And what is a US dollar? What does a higher US dollar mean? Well, that tends to disrupt a lot of risk markets. Sometimes it's an impediment to sometimes it's an impediment to stocks going higher, commodities and crypto as well. And with all the bearishness on the US dollar, and I totally buy that case, I think the positioning and the sentiment is such, it's so bearish that we could actually see a strong up leg. So that's something I'm going to be on alert for in the month of August. So tune into Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
Tesla's board has approved Elon Musk's massive new $29 billion stock award. Will that be enough to keep the CEO's focus aimed at the EV giant? Joining me now, Yahoo Finance senior autos reporter Pras Subramanian. This is less than the initial pay package that was approved and then rejected by a Delaware court. So what do we know about this one?
It sounds like it's going to address some of the issues about his focus, and it requires him to be there for a few years and devote a certain amount of time to the business, and that's sort of what people like Dan Ives are asking about in terms of what they want from Elon Musk going forward, and as the company approaches a critical phase with robotaxis and Optimus robots and all sorts of cyber cabs and all those things happening. So I think it's addressing those key issues. It's still a lot of money. I mean, I don't know any CEO making that much money in the span of 3 to 5 years. But yes, it is significantly less than that original pay package. It's still tied up in the court system still to this day. And they said that if one of those two gets approved, it wouldn't be a double dip situation where it would be one or the other. You couldn't get both. So that's going to address that concern too. So
what about the sort of ongoing questions about the board independence at Tesla? Those haven't really gone away, right?
Yeah, I mean, the board's confident that Musk was going to be okay with this package? Like, well, yeah, he's on the board. He sort of is friends with everyone there. Robin Denholm, the chair, is something that someone supposedly handpicked. I mean, so you have to ask that question. Is still in play as to how independent is this board? There's only one member who's independent, so that's really interesting to me.
Right.
And
there's also, of course, the cognitive dissonance between this headline, which, yes, we know was sort of a retroactive pay package, and the fact that the stock is down 25% this year.
Right, and then the core auto business is slipping quarter after quarter, and there's no indication that's improving. Yes, we have the new Model Y out now, but it was out last quarter and it was still sort of down a bit. So there needs to be something happening. We're not going to see that cheaper EV not till after the tax credit goes away. So a lot of question marks here. It is a pretty big pay package, but I guess if you're a Tesla investor, there's some certainty here with what Musk is going to be doing in his time at the company.
Yes, to some degree. Let's talk about another big story that you're following here. Boeing, some of its employees poised for a strike, the second strike that we've seen in less than a year.
Yeah.
Who does this affect? What do we know about it? How likely is it to actually happen?
So you're right. The defense unit their workers are striking, about 3,200 workers or so. This compared to the 50,000 or so that they're working in the commercial unit, right? So they make the F-15 fighter jet. They're supposed to make the new upcoming next generation fighter, which is a big deal that Boeing won a contract for. The defense business is profitable, which is more than you can say about the commercial unit right now, but it's much smaller in terms of revenue. Boeing made about $22.6 billion last quarter. About 6.6 of that was with the defense business. So it's a nice chunk, but it's not the lion's share there. CEO Kelly Ortberg said during the earnings call that he said not to worry about this strike. It was coming. They perhaps expected it. And he said it wouldn't have a significant impact on their business, and that they probably see a resolution coming in the next month or so. But we'll see. You never know. These things can extend. The last strike with Boeing's defense workers was, I think, around 90 days. It happened like 30 years ago. So it's a little rare. But
and the shares are not much changed today, so it sounds like investors are, they are reassured by what Ortberg has said. All right, thanks, Pras. Appreciate it. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Up this hour on Market Catalyst. First up, weakening labor market data upping the odds for a Fed rate cut. We'll have full coverage ahead. Plus, Disney results are due out this week. We'll break down everything you need to know ahead of that report. And for today's Stocks in Translation, we'll dig into the return of the red-hot IPO market. All that and more coming up on Market Catalysts. 90 minutes to the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets now. We do see a big rebound here in stocks today following the losses from Friday. Traders ratcheting up the odds of a Fed rate cut. That's sending the Dow higher by 474 points, about a gain of 1%. The S&P up about 1.2%. The Nasdaq leading gains up about 1.5%. We are also watching the India market, and that's because we just got some headlines from President Trump that he says he'll be substantially raising the tariffs paid by India. He says this is because India has been buying what he calls massive amounts of Russian oil. And then he says they are selling it on the open market for big profits. This saying coming in a post on Truth Social. As a proxy for the India reaction, we are watching here an ETF that tracks India shares, INDA, and you can see a leg downward taken after that headline. So we'll continue to monitor that as well as the rest of the trade developments. Well, Director of the National Economic Council, Kevin Hassett, saying the firing of the Bureau of Labor Statistics Commissioner is part of a complete overhaul of that agency. President Trump calling Friday's jobs report, quote, rigged, and saying he'll pick a stellar successor as he looks to add his allies to the Bureau of Labor Statistics to ensure, quote, reliable results. Joining me now, Gus Fauché, PNC Financial Services Group Chief Economist, and Yahoo Finance Fed Correspondent Jennifer Schonberger. Thank you both for being here. Gus, I want to start with you. This has really sent shockwaves throughout the economist community. I haven't seen anyone, I don't think, who said this firing was a good idea. What's your take on it and what happens next?
The Bureau of Labor Statistics has a great and well-deserved reputation for putting out reliable statistics. There's no politics involved in the process, and I think it's unfair for the president to claim that it's rigged. It certainly sends a very bad signal for the president to fire the commissioner of the BLS. And I think the idea that he would appoint his own commissioner increases the possibility that we do get rigged numbers sometime down the line. I'm hopeful that won't be the case, but this is very disappointing. We depend on these statistics. We need to know that they are reliable and not political, and this moves us further away from that.
And Jen, it's interesting because, in fact, the just fired commissioner of the BLS had talked about that maybe budget cuts were part of the challenge in data collection. And I mean, listen, I didn't listen to all of the commentary over the weekend from Hassan and others, but it doesn't sound like with the revamp of the department that they're giving it more resources, unless I missed something.
Yeah, it certainly doesn't sound like it, Julie. But I think the core of the BLS team that needs to execute the data collection is still intact. And I would just add that the BLS commissioner does not control the data. So to the president's point, it's sort of impossible that those numbers could have been rigged. So whoever he puts in place to replace Erica, I don't know. I mean, it certainly looks political on its face, but I'm not sure how much of an impact that's really going to have here unless there is direction to slant the numbers. That remains to be seen, and that would be hard to try to dig into whether that is something that is going to be done. So if we see another weaker jobs report and we have the president's new person in place, it'll be interesting to see how the president reacts there.
Right. I mean, do you just end up firing person after person if you don't get the numbers that you want? I don't know how that plays out. But Gus, when you look at the numbers themselves from Friday, I did see some commentary this morning that they were not, in fact, as bad as they initially appeared, in part because perhaps we're seeing a labor supply issue rather than a labor demand issue. What do you think?
I think they're bad. I mean, I don't think there's any way to sugarcoat this. We saw a substantial downward revisions to job growth in April and May. We've only added about 35,000 jobs over the past few months. Is it possible that some of this is due to deportations, restricted immigration? Yes, but that just means that the economy is, not in very good shape, that it's more susceptible to a downturn if we have slower labor force growth. That weighs on economic growth over the longer run. So sure, maybe it's because of slow labor force growth due to immigration restrictions, but that is a negative in and of itself. And I think the job market now looks a lot softer than it did just last week, and it does raise increased concerns about the potential for a recession in the U.S. economy.
Jen, we did hear some of the Fed officials commenting last week and saying they were sort of leaning into that immigration narrative. What did we hear from them?
Yeah, I think Gus makes a lot of good points, Julie, but if you listen to the vice chairman of the Federal Open Market Committee, New York Fed President John Williams, he still thinks the job market is in a solid place. And we heard similar comments from the head of the Cleveland Federal Reserve as well, Beth Hammack. But to Williams' point, he is looking at the aggregate data. He's looking at initial jobless claims. He's looking at quits. He's looking at job openings. He seemed to be more concerned about the downward revisions that we received. But to the point on immigration, he does acknowledge, we are seeing a more limited labor supply. So perhaps we're dealing with a labor market here that we know it's been cooling over the past year, right? We're continuing to see the no hire, no fire economy. And you have to wonder how much uncertainty is weighing on hiring right now because of the different tariff rates we're seeing. Perhaps once we get more certainty on that, the question becomes, will we see a rebound in jobs later in the fall? But I think when it comes to will we have a Fed cut, come September, come this fall because of the weaker jobs report we saw, that's not necessarily a slam dunk given what we're hearing from high-profile voices on the Federal Open Market Committee, we're seeing a Fed that's very divided over inflation, the impact of tariffs on inflation and the job market. And right now, they seem to be taking this report in stride.
Gus, what do you think? Does it, some of the folks I talked to last week on the back of the jobs report suggested that the Fed might be motivated to do a sort of catch-up cut given how bad those numbers looked. What do you think?
I think that the weak July jobs report trumps concerns about inflation right now. I think that the labor market is clearly softer now than we thought it was just last week. The Fed is focused on their dual mandate of both maximum employment and stable prices. I think that most Fed officials think that the impact on tariffs is likely to be temporary, that we will see a reacceleration in inflation, but then it will slow again toward the end of this year. And that given the concerns about the softness in the labor market, given that monetary policy is at this point already weighing on growth, I think the Fed will go ahead and cut in September, and then we might see a couple of more rate cuts over the next few months after that.
Of course, the irony about President Trump being upset about the report is it might be the thing that pushes the Fed to do the thing he wants them to do. But Gus, I also finally want to ask you about the implications of Adriana Kugler's seat on the FOMC now being open, President Trump being able to appoint someone or to succeed her. How are you thinking about the influence or the independence of the Fed at this point?
Obviously, the president has the ability to appoint the person that he wants to be on the board of governors, subject to Senate approval. The president has made it clear that he favors rate cuts, and so I'm assuming the person that he appoints will adopt that view as well. And I think this is likely a trial balloon. I think that, given that Chair Powell's term as chair expires in early 2026, I think it's likely that whomever the president appoints is going to be in the running to be Fed chair. But I think that, the president will be appointing someone who agrees with his policies, as he has the right to do. But I think that, it's going to be very interesting to see how all of this plays out over the next 6-9 months with Chair Powell and the president's obviously disapproval of his views, a new Fed governor, and the dissents that we saw last week, which were, we hadn't seen dissents by 2 members of the Board of Governors in 30 years.
Yeah, certainly it will keep us guessing and busy, and we'll catch up with you again, Gus. Thank you very much to Gus and to our Jennifer Schomburg. Appreciate it.
Thank you.
Coming up, Disney making a new $1 billion deal reportedly ahead of earnings. We'll talk about that and preview those numbers for you. ESPN reaching a deal with the National Football League for the rights to its Red Zone and NFL media assets. That was reported by The Athletic. It's the latest deal for Disney ahead of its earnings for its fiscal third quarter coming Wednesday, August 6th. And Doug Kreutz, TD Cowen Managing Director covering media and entertainment, is joining me now. Doug, it's good to see you. Before we sort of dig into what you're expecting for earnings, I am curious about your reaction to this report about ESPN reaching this deal with the NFL. And reportedly, it will give the NFL equity interest in ESPN. This is something they've been working on for years. Do you think this is a good deal for ESPN and Disney by extension?
Well, it certainly makes it so the NFL has a very real stake in ESPN succeeding, which, the NFL being the most important major sports league, that's a good thing for ESPN. The economics of the deal, I think that's a little bit of a TBD. We'll see how it goes. But with ESPN launching their direct-to-consumer product in the fall, and the trajectory of linear cable still remaining very much in question, I think having this vote of confidence from the NFL and again, sort of skin in the game is a good thing for Disney.
And what do you think the sort of role and functionality at this point of ESPN is within that Disney business, both sort of shorter term and then longer term?
Yeah, I think it's still a bit TBD. I mean, obviously it still generates a significant amount of cash flow for them, which they can then reinvest in other parts of their business. But as far as how it, kind of synergizes with the rest of their biz, they have people who have Disney Plus and have Hulu and maybe have ESPN too. They've got sort of a bundle that has not everything, but at least bits of everything. But recall that's really a US only product. So it doesn't help them as much globally. And I think that's one of the issues ESPN has is that because it's a US only product, you're sort of locked into a very mature television streaming market. Beyond that, I think it's still a bit of a question mark. I think it remains an asset where the very long-term future isn't super clear. Again, it's hard to see how a streaming only ESPN product would do well if there wasn't, some critical mass of linear cable subscribers that continue to be there for the next decade plus. And again, I think that's a very open question.
And speaking of questions and zooming in on the upcoming earnings this week, Doug, what is your biggest question going to be for the company sort of going in and awaiting those numbers?
Yeah, I think the question 3 months ago would have been, how the park's doing, particularly with Comcast Epic Park opening. There was some concerns with that cut into Disney's attendance. I think Epic has done well, but it hasn't done so wildly well that you would be really concerned that Disney was seeing, a major impact. Not that there won't be an impact, but I think everybody assumed there'd be some impact. And I also 3 months ago, people were more concerned about macro, and that seems to have receded at least a bit. I think that the more pertinent question is, they had a summer with 4 big movies. One of them, Lilo and Stitch, the remake, did very well. They had an animated movie, Elio, which did incredibly poorly and will almost certainly be a meaningful write-down. It's another original IP film that they have made that hasn't done well on the animated side. And it's not just them, it's the entire industry. Original IP animated films are struggling. They also had, I think maybe most concerningly, 2 well-reviewed Marvel films. One, Fantastic Four, which had a good opening weekend, but really had a major fall off in the second weekend. And I think in general, there's got to be some concern about the trajectory of the overall Marvel franchise and whether it's lost a lot of the interest that it used to have and was a key driver for them.
Yeah, I think we were a big Marvel household, and now we've got a little Marvel fatigue, I have to admit. And when you look at that parks question, how do you think they will be doing, given, to your point, the competition from the newly opened park in Florida?
Yeah, look, the parks business has been functioning very well. They had a little bit of a soft patch last summer, but it seems to have recovered. Again, I think Orlando will probably be a touch slower this quarter because of the Epic opening, but not so much that it's going to have anybody concerned. They've got multiple cruise ships are going to be coming to market over the next few years as an opportunity for them there to have additional growth. I think the parks business is good, right? It's going to continue to be good, sort of barring any major recession. I think everybody knows that, right? It's sort of, I don't know as an investor if you get paid for the parks business being good just because that's kind of baked into the stock.
And speaking about being baked into the stock, you've got a hold rating on it, $123 price target. What has to change for you to get more bullish on Disney?
Well, I think one thing is we kind of need to know who's going to replace Bob Iger.
Yeah, small thing, right, Doug?
Yeah, that remains a very open question. Will it be somebody internally? Will it be somebody from outside the company? We don't know. And he's supposed to be handing over the reins next year. He has been supposed to hand over the reins many times in the past, and he's still CEO after some time off. So we'll see. I think that's a really big important thing, and sort of whoever does replace him, what's their vision for Disney over the next 10 years? It won't necessarily be the same as Bob Iger's. And then I think it's the media business, right? It's how much can they grow Disney Plus profitability? I think that they can get it higher, but can they get it higher fast enough to offset the diminishing profits of linear? I think that's also another very open question that they have not been able to answer in any concrete way.
Right. Yeah. So we'll see if there's any hints on that direction in this earnings call. Probably not, but we'll see. Doug, thank you so much. Appreciate it.
Thank you.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's get a quick check on the market action about 2 hours into today's trading session. All three major indices holding on to this momentum that we see in the early innings of this week. The Dow, NASDAQ, and S&P 500. All in the green, all up about 1%. The NASDAQ leading the gain here, up 1.5% after that tech rally that got a bit of a sell-off on Friday is now regaining momentum. As we saw over the past 5 days after we got that weaker than expected jobs data, the firing of the Bureau of Labor Statistics director, as well as one Fed chair stepping down. Investors now trying to come to terms and understand all this latest data that we've gotten, especially as those ongoing trade negotiations are underway. The S&P 500 also still holding on and trying to continue that momentum that we really saw leading up in July. And now, once again, that sell-off on Friday as we're trying to reverse those gains, bounce back. This rally is undergoing as we make our way into today's trading session. I also want to take a look at some commodities. What we're really seeing here is oil under a bit of pressure after OPEC Plus agreed on Sunday to raise oil production by 547,000 barrels per day for September. And what we're really seeing there is this bit of a decline down about 1%. And really that's sort of offsetting what we've seen over the past month of a nearly 0.3% gain. Also taking a closer look at the NASDAQ, what's leading the momentum there. What we see is most of the NASDAQ in the green this morning. There we go, loading there. The NVIDIA up more than 2%, leading momentum there. We also are seeing Google, Microsoft, Apple, and Meta leading momentum there. Amazon a bit under pressure after that sell-off on Thursday after their weaker than expected Amazon Web Service data came out. Now that momentum continuing, or rather sell-off continuing into the week this week. Keep a close look. We'll be tracking all the market moves throughout today's trading session right here on Yahoo Finance.
Now time for some of today's trending tickers. We are watching Tyson Foods, Spotify, and American Eagle. First up, Tyson Foods raising its earnings forecast after quarterly profit unexpectedly rose. A boom in U.S. chicken continuing to offset losses in the beef business. Still with us, our Brooke DePalma. Brooke, you just talked to the CEO of Tyson. What did you hear?
Yeah, just jumped off the phone with CEO Donnie King, and there's really two names to the game here. They're being more efficient in their operating systems, and protein craze continues to bode well for Tyson Foods. Donnie went on to say that in this sort of environment, consumers are prioritizing protein. He said, quote, they're prioritizing protein over other foods, but they're also prioritizing food as essential versus the non-essential things like apparel, bigger ticket items. And he really went on to say that they have been efficiently and working at really maximizing their supply chain, maximizing their innovation, and that's boded well for them, causing them to raise their operating income as well as their revenue outlook for the year as consumers are really seeking out. We have low-income consumers seeking out the best value here. Then we have medium to high-income cohorts seeking out convenience, and that's boded well for their chicken business where they're getting the best bang for their buck, and that's really offsetting what we're seeing in their beef segment.
Yeah, and all across the board, to your point, buying that protein. Next up, let's talk about Spotify. Those shares are getting a boost after the company said it will increase the monthly cost of premium subscriptions in markets across South Asia, the Middle East, Africa, Europe, Latin America, and the Asia Pacific region. Those shares are up almost 7%, Brooke, as it does that price increase.
Julie, I was so shocked to see. I went to the Yahoo Finance data page and we're looking at shares of Spotify, and I did not realize that over the past year, shares of Spotify are up more than 100%. There's been so much momentum around the streaming space in general, and Spotify certainly feeling that momentum, especially seemingly that they have the pricing power here to really raise subscription prices there. Year to date, also we're seeing the momentum up nearly 50%. And so this is definitely one to watch as this streaming service unfolds. Also this pricing power in this environment where consumers are really, nickel and diming. They're really trying to get the best bang for their buck. But seemingly, Spotify believes here that they're able to raise prices in this sort of environment as well.
Yeah, and those shares, by the way, were trading at a record as recently as late June. They're still kind of near that spot. And finally, the Trump effect on American Eagle, not the place I would expect it, but American Eagle shares are spiking. President Trump coming out in support of the company's Sydney Sweeney ad, which has faced controversy since its release. The share's up by 17%. I guess I can't be surprised at the president weighing in on anything these days, but that wouldn't have been the first thing I would have picked.
Right. I mean, certainly American Eagle stock getting lots of attention. Over the past month, what we have seen is this momentum up nearly 23%. This has been a company that has been under heat, under pressure over the past year, especially as many apparel stocks have gone into the red after what we've, been concerned about, these fears over tariffs and their sourcing regions. And now seemingly this commercial getting American Eagle some positive attention here. And even over the weekend, this is a big story when it's Wall Street discussing this attention that they've got because of the Sydney Sweeney campaign. It's President Trump weighing in. And then you also have Main Street. All my friends were talking about it, Julie, over the weekend. And they were also talking about this marketing strategy, this technique of Sydney Sweeney so seamlessly just discussing the jeans without discussing the jeans. And now we're also seeing Dunkin' Donuts look to get in on that exact trend of, I'm not going to tell you to buy Dunkin' Donuts, but I'm going to tell you about it. And it seems like there's lots of momentum behind what this could become, of course, getting mixed up a bit in the meme stock rally as well.
Right. So were your friends thumbs up or thumbs down on the Sydney Sweeney ad?
My friends what?
Were they thumbs up or thumbs down on the ad?
They were just talking about it, and they just thought it was interesting. I mean, to have that sort of to want to buy them, to not want to buy them, but it'll be interesting to hear how the quarter sort of plays out when American Eagle discusses how well it did, I'm sure.
Yeah, if it actually boosts the numbers, we shall see. Thanks so much, Brooke. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's training tickers page. Well, rideshare companies Uber and Lyft are set to report earnings this week. Joining me now, Rohit Kulkarni, Roth Capital Partners Managing Director and Senior Research Analyst. And Rohit, it's so interesting because we're waiting for these Lyft results, but the company in quick succession first announced that it was closing its acquisition of FreeNow, which is a European taxi rideshare service, and then also signed a partnership with Baidu to then bring robo-taxis to Europe. So is that, how big of a change is that for Lyft?
Hey, thanks for having me, Julie. It is a sign. Exactly those two things are good signs of improving execution at Lyft. That's something that has been an issue all along, and that has been an issue amongst investors where Lyft has unproven potential, and with M&A, with partnerships, and just basic baby steps, left foot, right foot, indicates good execution, and that should be supportive of positive sentiment into earnings.
And as for the earnings themselves, what do you expect them to show?
Overall, I believe just the macro backdrop, lack of volatility due to tariffs, general FX related tailwinds, travel spend, high-end consumer, all these data points are coming together for both Lyft and Uber. There may be some pockets of inbound travel softness into US, but overall, we expect, we are clearly leaning positive into Uber and Lyft for their earnings. For Uber, we think they need slightly better than a small beat into the quarter. For Lyft, the bar is quite low. Near term, we are tactically more positive on Lyft. Uber, we like it. We love it a lot. Longer term, that's the one to own. So overall, I would just say leaning positive.
And for Uber, obviously, it is a more diverse business, which historically has been one of the reasons that investors have preferred it, right? It's also given it kind of flexibility when the mobility business isn't working as well. It leans into delivery. Yep. What is that sort of mix going to look like this quarter?
The mix has somewhat remained surprisingly stable and constant. One would think they would have slightly greater mix towards the delivery business, which has more kind of organic growth drivers just beyond restaurant delivery. They have ads business, they have grocery delivery, they have e-commerce delivery. So there are more organic growth drivers in the delivery business, but the mix has been 60-40 over the past couple of years, which is more mobility, and 40% of the business is delivery. Profitability in delivery has improved significantly over the last 6 to 9 months, so that has become more of a focus area amongst investors. On the other hand, on mobility, stating the obvious, what happens with robo-taxis, Tesla, Google's Waymo over the next 6 months is going to be a big focus area on Uber and Lyft's results as well.
Well, and who do you think between these two wins in autonomous? I mean, we've got this new announcement in Europe from Lyft. We have, of course, as you referred to, the Waymo partnership from Uber. Who do you think comes out on top?
In my opinion, kind of, it still remains to be seen, but the peak kind of fears of existential issues on the ride-sharing business because of robotaxi, I think from investors' perception, the peak robotaxi fears are somewhat behind us. The risk is still elevated. In a world where there are more robotaxis on the road, what is the role of Uber and Lyft? What is the role of Uber and Lyft going to look like is still TBD. But as more robotaxi partnerships with ride-sharing companies come to fruition, just as Waymo is doing with Uber, Baidu is doing with Lyft, and then there are other companies like Pony.ai doing with Uber in various different geographies. And so, in a world where there are many robotaxi offerings, the value of a marketplace like Uber or Lyft is going to be much greater than where we are today. So that's our anticipation, but that we still are in this kind of elevated risk zone for both Uber and Lyft, and investors very closely monitor robotaxi launches as such.
Yes, it's been an interesting story to watch. Rohit, thank you so much.
Thank you so much. Bye-bye.
Coming up, we got a crash course in IPOs with host of Stocks in Translation, Jared Blickery. We got more on that when Market Catalyst returns.
After the 2022 bear market, stocks were hitting record highs by early 2024. But the frozen IPO market has taken a little bit longer to warm back to life. And on today's Stocks in Translation, we are providing a refresher into IPO basics. Now let's start with the definition. An initial public offering is the first time a private company sells stock to everyday investors and gets its ticker listed on an exchange. It gives the company fresh cash. It also gives a chance to earlier investors to cash out, and it gives everyone a real-time price tag on the shares. Now let's check out a chart of IPO activities going back to 2020, the start of the pandemic. All the stimulus from the Fed and also from Congress, they quickly found a home in speculative corners of the market. Just as GameStop was peaking in early 2021, so did IPOs. There was $131 billion in IPOs offered in the US in the first quarter of 2021 alone. But the 2022 bear, it wiped out risk appetite around the world, and only recently has IPO issuance started to perk up again. There are a few steps along the way for a new IPO, and this begins with a bunch of preparation with the help of bankers, auditors, and lots of lawyers. The company's financials must be audited, and the lawyers draft what's called a registration statement that has all the docs that investors need to read. Now, this whole stage takes easily a few months to a year. Then in step 2, a company will file the package confidentially with the SEC, which is a stocks watchdog in the US. Government lawyers, they will then comb through the documents, and then there's a bunch of back and forth as SEC comments are addressed. This can easily take 6 months and often longer for smaller companies. And when it looks like the SEC is nearly satisfied, the bankers or underwriters, they put on a road show for investors to gauge demand for the shares. They will build what's called a book of orders to arrive at a price tag for the stock shares. This period is measured in days to a couple of weeks. Now, moving on, when the bankers decide on a selling price, that's called the IPO price, it's determined the night before the stock starts trading on an exchange. Most investors will not be able to get in at this price, and it's considered a privilege to get in at that IPO price. On what's called listing day, a market maker will try to align demand for the IPO shares with the supply of shares that the company is offering. And ideally, the stock will trade higher than the IPO price, which produces a gain for new investors. But guess what? It doesn't always work out that way. Finally, a lot of times shares issued at the attractive IPO price, they are locked up for a period of 6 months to avoid investors dumping the stock on the market to collect easy profits. Now this year, money is finally starting to pour back into new ventures, and we've seen some giant IPOs take place. As part of the AI trade CoreWeave, they raised $1.5 billion. But on the very first day of trading, the stock closed exactly at its IPO price. So no first day gain for investors there. Figma and Circle, on the other hand, they delivered some nice pops for investors, 250% and nearly 170% respectively, with Chime just a little bit lower on the list. And there's still a number of unicorns or private companies of $1 billion or more in value that are waiting to IPO, from Klarna and Stripe in the fintech space to Cerebra Systems in AI to the Winklevoss brothers, Gemini crypto exchange. All in all, IPOs can present opportunities for investors, but before jumping in with your eyes closed, remember this. Over 90% of IPO stocks, they trade lower than they did on their first day of trading. And more than half the time, that happens within 3 weeks. So you can usually wait for this stock to come back a bit before dipping in. And thinking about the long term, only 1 in 5 new IPOs doubles in price their first year. A word of caution for those who like to swing for the fences. So always remember, you should treat these as riskier than average investments. And tune into Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website, or wherever you find your podcasts. More market catalysts after this.
Investors have a busy week of hospitality and leisure earnings ahead, starting with Marriott on Tuesday. Results will give Wall Street insight into discretionary demand and the spending habits of the average consumer. Here to discuss is David Katz, Jefferies Managing Director. David, good to see you. So we've already heard from a handful of hotel chains. We're going to hear from more, as well as get more into casinos and gaming this week. But I'm curious what your impressions have been so far from what we've heard, and how that sort of informs what we might still end up hearing.
Yeah. So, look, I think getting ready for Marriott, one of the perspectives that we bring to it, having seen a number of the hotel companies, is that the volumes and pricing environment is really inconsistent. There are challenges with inbound international travel, particularly from Canada. We've seen certain segments of business travel been strong versus weak. We've seen low-end RevPARs be persistently low. But fortunately, when we look at companies like Marriott, because of the business model and their ability to continue growing their units or their NUG, they're able to continue growing their base of the core business. And they also get growth, as we know, from an ancillary business, their co-branded credit cards and other royalties that they derive that are actually even growing faster, Julie, than the core business at this point. And so, we're very focused on those business models and their ability to keep growing even in a really herky-jerky earnings environment that we've been experiencing.
Well, it's interesting because you're not the only one who I've heard talk about this net unit growth theme this earnings season. Is that just is the answer volume in a lower RevPAR environment?
Ever since 2019, right? If you look back at historical RevPAR, particularly in the United States, it's been relatively anemic. It's been a low single-digit number, notwithstanding the COVID recovery in that period. But from a like-for-like basis, RevPAR has really not been a driver of these businesses for quite some time, right? We're in year 6 of this. What's been driving those businesses is NUG and their ability to grow their system size. Now, some of that has changed, and that provokes an interesting debate because, the new build of hotels has slowed, and more of what they're getting are conversions, either from independent hotels or other brands switching into theirs, right? And then more recently, we've seen these affiliation deals. Like, for example, Marriott has a Bonvoy deal with MGM for the Las Vegas Strip, where it's not the same economic intensity as a traditional deal, but it's more rooms in the system and it's incremental fees. And so that growth continues and it begets the ancillary growth that I described earlier.
Interesting. So you want sort of more well-grounded, different sources of revenue. Unless people's eyes glaze over, again, just as a reminder, NUG equals net unit growth, RevPAR, revenue per available room. On an anecdotal basis, it doesn't feel like increases in hotel rates, room rates have been slowing down, just as a consumer, right? But you know, sort of situate that for us, contextualize that for us, what rates have been doing.
Yeah, and Julie, I'm guessing that the finer places that you choose to stay, you know, are probably still able to raise their rates because if the market will bear it, they'll keep doing it, right?
So it's my fault. I need to refuse to pay it, I guess is the answer.
You need to choose to stay somewhere else or choose an alternative vacation. But when you look across the different segments, right, the economy and the limited service segments have been negative for quite some time. Other companies in our coverage, for example, Wyndham, Choice, that's where they primarily operate. And it's been holding those stocks and their valuations back just a little bit. The luxury end of things is still getting some rate growth. The higher end resorts for a while paused and are now back getting some rate growth. And one of the important drivers we should touch on, you know, is group business, right? Where conventions are a function of the business economy and they are still producing, you know, reasonably good growth. Although we heard some commentary about maybe some slowdown in the back half of this year, but so far they've been operating well. The most important thing, Julie, to remember is that RevPAR lasts for a day and NUG, you know, could last a lifetime.
Right, makes sense. And just quickly, before I leave you, I do want to ask you a question about the sports betting stocks. Ahead of football and all of our winter sports, is now the time to get in on those stocks?
There is absolutely a seasonal focus from Wall Street on sports betting. These companies will often spend a fair amount of promoting and marketing in most of 3Q until the football season starts. Historically, football has been roughly 40% of sports betting volumes here in the U.S. And so we do expect there's going to be, you know, an increasing interest in sports betting stocks as we go forward. I do want to point out we're spending a ton of time working on the prediction markets, right, and their legality and what they mean for their presence within, you know, the sports betting market over time. But I'm glad you brought them up because they are going to become a much more focused subgroup of our coverage as we get into the ensuing weeks.
Well, good. We'll have to catch up with you again on that and on that prediction markets, which I agree are pretty fascinating. But David, we got to leave it there for now. Thank you so much. Appreciate it.
Thank you.
That's it for Market Catalyst. I'm Julie Hyman. Thank you for watching. More Yahoo Finance coming up.